Welcome back to Debits and Credits with Haas and Dawe, and we're going to continue our conversation about lease accounting. We're going to continue our conversation about what lease accounting means as it affects your balance sheets. And so let's just talk about office leases because that's sort of the most common one and probably the one that has the biggest impact. So you sign a lease for your office space, and let's say it's a 5-year lease, and let's say you're going to pay $2,000 a month worth of rent. And so it's for one particular year, 12 months of rent payments is $24,000. Now, as we talked about in our prior episode, this $24,000 is that a current liability because it's what's going to be due. It's a liability that the company owes for the next 12 months of operations. And now how this calculates, because again, this lease accounting standard seemed pretty straightforward, a concept that you will have the leases will be on the balance sheets. And so the liability is going to be 12 months of lease payments. Now, what we didn't talk about yet, which we'll talk about in a minute, is also affects the asset part of the balance sheet too. Because as we talk about debits and credits with Haas and Dawe, there's got to be a debit, there's got to be a credit. The liability is a credit, there's going to be a debit that'll be on the balance sheet as well under the asset section. Now, but what FASB has said, and we remember the FASB is the acronym for the Financial Accounting Standards Board, in following GAAP, which is the acronym for Generally Accepted Accounting Principles, has said, well, there's somewhat of a time value of money when we talk about the leases, and there's some sort of embedded interest rate as far as what's going on with the occupancy and the right of using the office space. And so, as an approximation, you can probably take 95% of 12 months of payments to come up with about what the liability is going to be. There's a whole calculation involved, and it can be complicated at the point once you start getting into what's the term of the lease, what how the payments come out, what's the embedded interest rate, and so on. And so that's what hits the liabilities. Now, if you're an escrow company regulated by the Department of Financial Protection and Innovation, acronym DFPI, then you have certain requirements. It's in section 17210, 17210 of the California Financial Code. And it talks about liquidity, that the escrow company has to have enough money in the bank, cash, it can be marketable securities. For the most part, it's the liquid assets of the company. That number's got to be more than the current liabilities of the company by $25,000. So let's say you have $100,000 of money in the bank. Your current liabilities cannot be more than $75,000, or you'll fall out of compliance with this requirement of Section 17210. Now, if it's a situation where it got to be frustrating for these escrow companies is that on December 1st of 2022, the leases weren't on the balance sheet at all, and they could have had $100,000 in the bank, and they could have had $70,000 worth of liabilities. The difference being $30,000, and they're in compliance. Well, then on December 31st, when we came to do the audit of 2022, all of a sudden this new standard took effect. So now these $24,000 worth of lease payments within the next 12 months comes onto the balance sheet as a liability. And current liabilities goes from $70,000 to $94,000. And now they've gone from being in compliance to being out of compliance. Just because we, the accounting world, decided to pass this standard and create this new liability on the financial statements. So that's been a difficult burden. Now, if it's for the people who are underwritten title companies and they're under the Department of Insurance, they have a different requirement. It's more of working capital. So it's current assets minus current liabilities has to be greater than $10,000. So it's a smaller standard amount to meet, but it still has complications. Because now, again, these lease payments, these 12 months of lease payments, this $24,000 is now hitting as a current liability, and it may take them from being in compliance to being out of compliance. So this is the impact that this has that we have to be concerned about. Now, the other impacts are not just on this regulatory scheme with the Section 17210 for the DFPI companies or with the Department of Insurance provision. Let's say you've got a loan with your bank, and it could be a line of credit. It can be a term loan where you borrowed $100,000. It's being paid back principal and interest payments on a monthly basis, and the bank is going to say to you, "We're going to lend this money to you but there's certain covenants, they call them loan covenants, that you have to follow. And every year we're going to check on you. So we're giving you a 5-year loan, and let's say we're lending you $100,000. It's got a 6% interest rate. It's due in 1 year, and you're going to have monthly payments to pay this thing back. But and let's say it's a 3-year term. Let's just make it a 3-year term. And so you're making monthly payments. And so 12 months of payments, or the not of the whole loan, but of the principal amount that's due, is a current liability. And so, and the lender's going to say to you, well, for us not to call the loan, you have to continue to have either so much liquidity or so much in the way of capital in the company, or you can't have an operating loss of more than X number of dollars. There are certain rules and covenants and restrictions that they're going to put on you, that for you to maintain the loan, you have to follow these covenants. Otherwise, they're going to call the loan. And so now, by adding this lease liability onto your balance sheet as a current liability, it can be affecting the loan covenant and create some issues for the financing arrangements. Now, one thing FASB said back when they created this accounting standard is they said, we're going to give it some time. That's why it came out in 2014. It finally got passed and put into place. We're going to give you a couple of years to implement, because they were telling people, you can talk to your lender, you can talk to your bank, you can talk to whoever had loaned you money to work out the covenants, to maybe do a refinance on it, which is fine and has a good intention to it, but they didn't address the people on our world, from the escrow companies and the title companies, of the regulatory covenants. They only talked about loan covenants. They didn't take regulatory covenants into consideration at all. And so that made it difficult for these companies to continue to comply. And so what we're going to do in our next episode regarding lease accounting, we're going to talk about effects, how to fix things, how to work things out, parts within the standard that are of a special nuance that may help people find some relief from being beaten down by these regulatory covenants and not meeting a requirement because of the lease accounting standards. Stay tuned. Next episode coming up on lease accounting from Haas and Dawe.